Welcome back, everyone. So I'm here with another analysis of a different company. This is going to be a different way than what I did last time because I think last time was a terrible visual for anyone who wanted to look. But today we're going to be looking at a company called Mercado Libre, or MELI, on the stock market. This is actually one of the positions I'm looking into buying more of. And after this analysis, I'll show you why. You'll understand why I have that position. So first off, what is Mercado Libre as a company, right? As a company, they're kind of like Amazon for sales in South America, but then they also have a fintech aspect. So it's almost like if you have Amazon, but Amazon was also providing you the credit to buy from them, right? It's a really good business model, which is proven in America. And it's definitely something where if you can combine something like MasterCard, Visa, and Amazon, that would make an amazing company. And this is kind of what Mercado Libre is able to do. That's what they're leveraging themselves to be able to do. It's currently available in 18 countries in Latin America, especially some of the bigger ones, right? So countries like Brazil, Argentina, Mexico, they've just started being more aggressive in trying to get market share in Brazil. So that's going to be contributing to a slight decline in their margin that we're going to see in some later slides. That's just a broad overview about what Mercado Libre does, and let's actually get into the profit and revenue history. So the revenue growth, right? This is at the bottom here. What we see is revenue per share here. Uh, it's just a straight line up. I don't know what else I can tell you. It's just a steady, what looks to be 40% median. That's the median growth for them, 42% year over year for the last 10 years. And the CAGR for the last 5 years has been 53%. I don't know of any other company that's growing this fast quickly, partially because a lot of big companies are already ingrained in their respective environment, and also they don't really have the growth of the countries themselves behind them, such as like the United States. It doesn't really have as much growth potential as some less developed countries like Brazil or Argentina or Mexico. So those are some tailwinds that we can actually see and that is actually seen here through these profit and growth and revenue growth margins. We see there's a slight dip on the earnings in the earnings history, and I'll show you where that comes from. That really comes from the dip in the revenue, right? The current revenue net margins is around 8%, right? We can see that in 2020 they were taking a massive hit due to COVID, but the margins have been slowly getting better and better. I believe historically before COVID they had margins of in the low teens, right? So it's not unreasonable to think that they can get back to that operational leverage once they complete however much up market share they actually want to get. So currently 8.5%. It's not very unlikely for them to get to 10% within the next 5 years, and that's really how far out I'm going to be projecting. So altogether, right? Let's take into account the profit, the revenue, and the margins. So assumptions, I'm going to assume, let's say, if they have a revenue growth rate of 30%, which is below the median and the current average price, right? Sorry, not average price, but the average growth rate. That actually, well, assuming that 30%, which is reasonable, right? And then a 10% profit margin, which is slightly above what they currently have, which is also, as I said, relatively rational. We get that they actually have a intrinsic PE, intrinsic price of $48,000. So on here, what we see is essentially the profit. I am using a PE at the very end of, I think, 50 here. So I'm sorry, I didn't put that in here, but this is also assuming a PE of about 50 here. I think actually it's 55 because currently they are trading at a PE of about 60. So even with that being said, that still gives them a price today that I would be willing to buy this company for at about almost $5,000. Well, I'll get to what they're trading at right now, but it's severely below this value. Next up, let's take a look at the free cash flow analysis, right? So the free cash flow analysis, they've had what we can see here, right? There's a recent dip in free cash flow, but over the last 10 years, the median growth has been about 35%, right? And their 5-year CAGR has been 65%, 60%, which is ridiculous. Once again, I don't know how else to put it, but it's amazing growth as a company. And it's definitely something I do want a part of. And if we take a look at the price per free cash flow, the median over the last 10 years has been 60 and a 0.5, 60 and a half-ish, 60.7, while the average has been about 36. So that's also on the high side. Currently, in the last year or two, they've been trading at a free cash flow of about 16. So they're definitely not at an inflated level compared to what they are at previously. Anyway, that being said, let's take a look at these assumptions here. Assuming a 30% growth rate, which is what they've been able to get for historically, which is slightly below the current growth rate too, right? Currently, they're slowing down a little bit, as every company that's growing this fast, you would expect them to slow down eventually. But they are assuming that 30% growth rate, and that you're able to sell them at their current price of free cash flow, which is $16 per share, and accounting for, I think, a $200 per share of debt per share, then you still get an intrinsic price here that I would reasonably understand. It would be understandable to buy that at about $5,100. Once again, that does match up with what the calculations were with just the revenue and the earnings. So none of both of these calculations give us about the same value, which makes me somewhat confident in these numbers. They don't currently give a dividend, so I'm going to skip over all the dividend stuff for today. So what is the overall price? Right? They have ridiculous revenue growth. They have ridiculous free cash flow growth. I I can't really say anything bad about them. What is the price that I would be pushing on them right now? Probably 4,900. I can see very reasonable that you can get that 15% required growth rate and in excess, right? With the growth they're having right now. The current price is only 2,300, almost 2,400. So I do think that Mercado Libre is a very strong buy today. I'll probably be adding more of this company to my portfolio and maybe even repositioning some of my portfolio to take advantage of this ridiculous opportunity. I There really isn't much I can see wrong about the business model. There isn't anything wrong I can see about the growth. There's nothing wrong about that I can see about the revenue, the earnings, the margins, the free cash flow. There's no red flags on about this company, and it's growing ridiculously fast. And it just has some of the best fundamentals. Well, not the best fundamentals, but a lot of its KPIs have been getting better and better as well. So I really do think that this is a really good company. If you are looking to buy into the stock market, this is a company that, even though they are trading at a very high PE, I still think because of their future growth, it is a very strong buy right now. That'll be it for today. Let me know what you guys think of my analysis. If there's any companies you guys would like me to cover, and if there's any other things you guys would like to see me do. Thank you so much.